Welcome back. Sorry it's been a while. I've been super busy with a lot of personal stuff. My full-time job has been crazy, taking up like all my free time, and then on top of that, been moving from one house to another house. But anyway, in the moving process, one thing I've noticed is that I've spent a ton of money at Lowe's and Home Depot. So naturally, I've been wanting to look at their stocks, right? But I picked Lowe's for a couple reasons. The first reason is that I think just at first glance, it's a little bit closer to fair value. Like the PE's like under 20, whereas Home Depot, I think, is above 20. I know that's not, the only way to judge a company, but still. And then the second reason is that we've never really talked about Bill Ackman on here, and Lowe's happens to be his number one position. Okay, so let me pull up Bill Ackman's 13F filing. So this is Bill Ackman's firm's 13F filing. This is everything they held as of March 31st, 2022. So I haven't seen the one that for the second quarter yet, but we're just going to use the first quarter one. All right, so Lowe's was their number one holding, 20% of their portfolio, down a little bit from 24%. They sold some. I don't know if they sold because it was going up above like their comfort level for like how big of a holding should be, or if they think that there's other opportunities out there, but we'll find out, I'm sure, whenever they publish their next 13F. But anyway, even if they're selling a little bit, if somebody like Bill Ackman has something as 20% of his portfolio, you should be paying attention, all right? Now, he is a really interesting investor. I don't think he's like other value investors that we cover. I think he has a tendency to hold a lot more expensive companies, if that makes sense, like Chipotle. And that's this one right here, CMG, which is 18% of their portfolio, is selling at like 60 times earnings, all right? I love Chipotle. I spend a lot of money at Chipotle. I think it's an awesome business, but I do not like the stock because it's selling at 60 times earnings, all right? But this video is not about Chipotle, it's about Lowe's. So what we're going to do is look at Lowe's financial statements and see if we can come up with a fair value of our own. We're also going to use it as kind of a teaching tool because I think that this stock is much different than other value stocks we look at, and try to figure out what Bill Ackman sees in it that makes it, 20% of his holdings, all right? Okay, so let's start with the income statement. Before I start, I think you realize like I barely talked about the stock price trend. I think I'm done talking about that. I think it's kind of a waste of time. I don't really pay attention to like what the stock price was 3 months ago. Is it recovering? Is it in an upswing? That means nothing to me, right? I want to look at the financial statements, find what fair value is, and then see what it's selling at now and see if, we can buy it at a cheap discount to that fair value, right? With that out the way, total revenue, this is every quarterly report going back to 2012, to the first quarter of 2012. What you're going to see here most of the time is that since these are quarterly numbers, you're going to have to multiply by 4 to get like the yearly estimate. But also if you see TTM, and we're going to get to that, that means that it's a yearly number for the trailing 12 months. You'll see as we go. All right, so total revenue, what we like to see here is growing, okay? And total revenue is growing. I mean, that's obvious. This is why we put stuff on graphs, right? To see movement, to see, upward trajectory instead of just looking at numbers on a table. I think that's gross. But anyway, we like to see that upward trajectory, and there it is. All right, next up is what? Margins. All right, so we're going to look at gross margin, operating margin, maybe some other type of margins. All right, so the first thing is gross margin. So gross margin is a great way to judge a company's competitive strength. So what does Lowe's do, right? They like buy these goods and they literally resell them. They're not making products, so their gross margin is a huge indicator of competitive advantage. It's how much are they able to mark their products up and still maintain sales, okay? And what you'd really want to do is compare this to like Home Depot's gross margins, because that would tell you, are they competing or are they lagging, that sort of thing, all right? So as far as this gross margin goes, it's good, especially in high inflationary periods. We do not like to see a shrinking gross margin, because that means that, the company isn't able to pass those increased costs on to the customer. So if gross margin's stable, it really means that like inflation's passing right through them, right? Okay, what's next? Let's see, the operating margin. Do I even want to look at that? Okay, yeah. So operating margin is something else that we look at to judge competitive advantage. And really we like to see to make sure that it's at least steady if the gross margin's steady. And look at this. This is awesome. So operating margin's actually increasing. And I'm going to do this. I'm going to say your operating expenses divided by your gross profit. So what this is going to tell me is, okay, so you have your gross profit. What percentage of that gross profit are you spending on operating expenses, right? That's things like selling, general, administrative. That's like wages or the equipment, that sort of thing, right? Pretty much everything except the cost of the products that you're buying and then reselling, okay? So this is actually really strong, because what this is showing is that your operating expenses are going down as a percentage of your gross profit. So you're spending less of a percentage of your gross profit than you were previously. That's like a really good sign. That shows that the company is running more efficiently. So that's definitely, worth something. All right, next we're going to look at interest payments divided by operating income. I like to look at this because I think it's kind of an interesting way to judge a company's debt load. You know, you can look at debt on an absolute basis on the balance sheet, but what you're really interested in is like debt compared to earning power, right? Because, you know, a company that's, let's say, is paying a ton of dividends or doing a bunch of share buybacks, they're not going to have that much on the balance sheet, and you'll see that with Lowe's. So if you look at it on an absolute basis, it'll look pretty ridiculous, the debt load. But if you look at it as a percentage of their earning power, then it might look a little bit more manageable. And that's the case here. I mean, you can see we're below 10% recently and shrinking. So either their interest payments are going down or their operating income's going up, or both. Either way, it's a good sign. Still, I mean, I'm very picky. I'd rather this be close to zero. You know, pretty much every company I own, now that I think about it, is like in the low single digits. So like 1 to 3% usually of their operating income is interest payments. But it's not every company I own, but most of them. But anyway, this is still okay. All right, let's go to pre-tax income. All right, so what we're looking for here, of course, is growth, all right? And what I've done in previous videos, and I'll just do it in this section for now, is I think a great way to just like estimate fair value for a company is to just kind of look at the graph like this of its pre-tax income, maybe project it out like a year or two and say, okay, if it's going to make that much money, you know, let's say it's going to be $3 billion, all right? So let's say they're going to make $3 billion in 2023 per quarter. I'll multiply that by 4 to get a yearly number, then multiply that by 10, and then just kind of like ratio that to the share price, and that'll be like a rule of thumb estimate for fair value, right? So divided by the market cap times the share price. I think like right now, roughly, this is a super rough estimate, they're probably worth $187 a share. And what I'll do is I'll do that with any company somebody tells me, right? It's like my first check. I go look at their income, make sure they're selling somewhere, you know, not ridiculously higher than pre-tax income, all right? This is not that far off, so I would definitely continue the search because, you know, there are some companies that are undervalued at higher multiples because they have a much higher growth rate considered, right? The reason that this rule of thumb isn't always accurate is because if you're expecting revenue to be up here at $5 billion in 5 years, then it's super undervalued at the moment, right? Okay, but I don't want to get off in a tangent. What's next? All right, earnings per share. Okay, so first I want to show you this is earnings per share for every quarter, but what I've done is I've taken the trailing 12 months. So that's going to do is sum the last 4 quarters for every quarter. It's just going to smooth the graph out, and you'll see what I'm talking about. All right, so this is the trailing 12 months diluted earnings per share. Now, this is a full year number, okay? So don't multiply this number by 4. This is a full year number because it's the last 4, basically what it is it's the last 4 quarters of earnings for each quarter, okay? So look at this growth. This is insane, all right? This is awesome. I mean, you went in 10 years from under $2 a share, 160 to 12. I mean, what is that growth rate? 12 divided by 168? So that's 7 times in 10 years. You raise that to the 1/10. I mean, that's 22% growth rate over a 10-year period, which is really impressive. And look at this. Most of that growth has come recently, you know, in the last 3 or 4 years. So very, very intriguing. I'm going to put for the growth rate, I'm going to say 20% historically. And then we'll decide from there if we're going to use that in our valuation or whatnot. But that's what the number has been historically, okay? The earnings per share right now is $12 a share. All right, let me look at this growth one more time because, you know, this is going to be a huge factor in the valuation, right? Whatever growth rate you pick skews your valuation like super crazy. It's one reason why I'm very conservative on growth because I think that it's super, super deadly if you assume 20% growth for 10 years or something. And even if it grows at 10% a year, you could wind up paying way up for something. I think that happened to people who were like buying Facebook above 300 and stuff like that. But anyway, that's beside the point. So do I think it's going to level off? I don't know. Let's say what kind of growth rate would it take to get to 14 from 12 in, let's say, 2 years? So 14 divided by 12. Yeah. Oh my God. Can't even do the math anymore. 14 divided by 12 raised to the 1/2. So that'd be an 8% growth rate. I think that's super reasonable. Okay, anyway, that's for later on in the video once we get to valuation. I'm just trying to figure out what I think the growth rate should be. That's enough of the income statement. Let's go to the balance sheet. My favorite thing to look at, I think, in stocks is the return on assets. I think it just intuitively makes the most sense. And it offers a little bit better protection than using return on equity, because if you use return on equity, you can get snookered by, high debt and stuff like that. So anyway, return on assets is one of my favorite things. And what we're going to do here is look at that for Lowe's. All right. So before I look at return on assets, I like to look at the total assets. So is total assets growing or staying the same? It's growing. It looks like it's, plateaus, takes a step up, plateaus, step up. Okay, so anyway, we're at about $50 billion right now. Is that what that says? Yeah, $50 billion. So what is the return on assets? And this is trailing 12 months. Let me put it back in percentage. All right, this is awesome. 16 to 18% return on assets. So remember how I was talking about them running more efficiently with the operating income being, the operating expenses shrinking as a percentage of the gross income, as the gross profit? Well, this is another indication of super efficient operation, all right? So if you're growing return on assets, that means that management's becoming more efficient with deploying capital, or the business in general is just becoming more efficient at earning money on the things it owns, or just becoming more successful with new investments. So anyway, however it's coming, it's great. Okay, return on assets being, growing like this is just awesome. And I mean, look back at assets. Let me put it back into dollars over here. But I mean, the assets in that 10-year period didn't really grow that much. So remember, your earnings went up like 7 times. Okay, so earnings went up 7 times, but assets really only went from 30 to 50. So like 50 divided by 30 is 1.6. So you had a 1.6 time increase in your assets, but your earnings went up 7 times. That's like magic, right? That's really cool. Okay, definitely a huge check mark, huge plus, whatever you want to say. All right, now we're going to look at inventory, all right? Because inventory is critical for a company like Lowe's. And in my opinion, it's really a leading indicator of future earnings. And this is something that, I don't know, his last name's Thornton, but he wrote a book called Quality of Earnings. And there's a chapter that really talks about the importance of looking at receivables and inventory, especially in companies like Lowe's. So anyway, why is inventory important? Because if inventory is growing, it means that more is piling up on the store floors instead of being sold to customers, right? So that's not good. What you want is, you really want inventory to be stable, because if inventory is growing, like I said, it's a bad thing, right? If it's shrinking, it could mean that they're in a supply crunch, right? It's kind of what everybody's facing right now. So the fact that they're not doing that is kind of interesting, all right? But anyway, that is not a good thing by itself, but you cannot look at inventory absolutely like this. What I like to do is look at inventory like as a percentage of your total assets. Is my percent inventory as a percentage of my total assets going up? And the answer is yes. But you'd also really have to look at like this inventory number, and I don't have that on this chart. But what you'd really want to do is go to the 10K, look at the number of stores, take the inventory per store, and make sure that's not drastically going up. I don't think this is a huge red flag. It's definitely something that you want to dive into a little bit further if you're going to invest, but it's not that big a deal. All right, what's last? Total equity. Okay, here is the first head scratcher about Lowe's. All right. Look at this equity. This is all your assets minus your liabilities, negative. So in my limited education on stocks, I've kind of like made my rule that I don't invest in things with negative equity. Now, I've since, I think, been not proven wrong, but I've seen a lot of things that challenge that belief, things like Sleep Number and now Lowe's, which, I said already, return on assets is my favorite thing to look at. And the return on assets is great, growing, and yet they have negative equity. Okay, so it's kind of confusing to me. This means that like the company's upside down, right? That they owe more money than they own. But at the same time, what I'm trying to wrap my head around is that it's not as big of a deal if your earning power is so strong that you have so much money coming in. Right? Because like, even though they have a equity of like negative $6 billion, negative $7 billion, they're making like $3 billion a quarter. So within a year, I mean, just that's flipped. So that their earnings power is so strong that I think that this is not as big of an issue. But still, it's just really weird to me, and I'm just not used to it. All right, but that's enough of the balance sheet. Let's go to the cash flow statement. First thing we're going to look at is free cash flow, and this is trailing 12 months. So kind of similar to what I did for the diluted earnings per share. Now you got to remember, this is not on a quarterly basis anymore, even though these numbers are every quarter, because it's the trailing 12 months value. Okay, so free cash flow growing, not growing as much as the earnings were growing. Okay, so that's a little bit concerning, and I'm kind of surprised, to be honest, because like Bill Ackman, I mean, I always thought he was all about the cash flow, right? He used to always say, I think there's videos where he like his formula or whatever, not formula, but his investing philosophy is like simple, predictive, free cash flow generative companies, right? So it's like he only cares about simple, predictable free cash flow. And I mean, I said on a pre-tax basis, they're making $3 billion a quarter. They're really only making $7 billion in free cash flow for the whole year. So I mean, that's close to half of their value of pre-tax income. Pretty interesting. I don't know. It's something you'd have to understand further. Like, where's the cash going? Because free cash flow is your cash from operations minus your capital expenditures. So you'd want to look real quick. I know it's not on the outline, but I'm intrigued. I want to see, is operating cash flow going down, or are we CapEx and a lot more? Okay, so operating cash flow is kind of stable. So where's your CapEx, capital expenditure? Yeah, I mean, they are spending a lot more. They had a step change in capital expenditures, but still, I mean, it's not that much money. It's only 600 million a quarter. It's interesting, just something you want to look into more, right? All right, let's look at dividends and repurchases. How much money are they returning to shareholders? All right, cash dividends paid. And this is going to be a negative number because it's on the cash flow statement and it's leaving the bank account of the company, right? So dividends and repurchases are going to be negative because they're leaving the company. All right. And this is great, right? Look at this. The dividend's just been steadily increasing every year. And right now it's what, $563 million a quarter. So 563 times 4, so $2.2 billion. And I said that their free cash flow was 7, roughly. So let's see. Okay, so divided by 7,000 because it's 7,000 million. Anyway, 32% of their free cash flow is going out into dividends. All right, in my opinion, that really kind of gives them a pass for the equity, because what it's showing is that they're just sending out so much money to shareholders that it's hard to grow the equity of the business if you're sending the money out, right? It's very easy for a company to just pile up cash and not do anything with the cash and look like its equity's going up, but to see that is to see equity like we saw. I mean, I'd rather see it going up and see dividends, but you know, if I had to pick one way or the other, I'd rather see I don't know what I'd rather see. Probably this though. All right, and then lastly, repurchase of stock. Okay, wow. Now this is really impressive. Holy cow. $4 billion in a quarter, 2 quarters in a row. That's ridiculous. I mean, like in a good way, right? That's an insane repurchasing. Wow. That's like all of their free cash. I mean, not all of it, but all their free cash flow is going out in like dividends and repurchase. No, that is like all their free cash flow. That's like all their income, right? So they're making $3 billion a quarter in pre-tax income, but repurchasing $4 billion of shares. I mean, that's great, especially whenever you see like that they just started doing it in like the last 2 years. It means they think the stock's probably undervalued. If management knows what they're doing, then, and it seems like they do, because they're, you know, all the other indications point to yes with the return on assets, with the lower operating expenses. So if management knows what they're doing, they'll rebuy shares whenever they think the stock's selling at a discount and they can't make more money by reinvesting in the business than they could if they rebought the shares. And so this is a huge bull signal. I think this is very strong. All right. Well, anyway, that is the cash flow statement. Let's go to valuation. So for valuation, what I want to do is just lay it out like this. So it's just a future PE valuation, right? So it's going to be, what are the current earnings? How many years, what's the growth rate, and then what's the future PE, okay? So, for example, or, you know, let's go through it. $12 a share is what we said they were earning per share. Let's do 5 years of analysis. Earnings growth rate. What do I want to put there? I'm not putting 20%. 20% would get you a ridiculously high number, and I think 8% is probably the low end. So let's do 12, okay? I'll do 12%. They're going to grow earnings at 12% for the next 5 years. That puts them a PE ratio, let's say 15 for a PE ratio. And then discount rate. All right, I've been flip-flopping on how I should do the discount rate. For the longest time, I did 15%. And I think that's good, but I watched a video from Warren Buffett recently who said, you know, his philosophy was you take conservative but not too conservative assumptions in all of these, including the discount rate, and then you just apply a large margin of safety. I don't know. So I'm going to do 12.5%. Really though, what's more important about the discount rate is that you discount all the stocks you analyze the same, because then you can compare them all. It's apples to apples, right? If I discount this one at 15% and another one at 10%, of course the other one's going to look like a higher valuation, but it's not the case, right? You want to just always discount it the same. So for that reason, if I did discount it at 15, I'd have a net present value of 160. Okay, so I think the fair value is between 160 and 180 probably, but that's assuming a 12% growth rate, okay? If you think it's going to grow at 20% for the next, 5 years, which would be insane, but, that's what they did for the last, 10 years, really. Then right now, even at a harsh discount rate of 15%, fair value is 220. So you're still, 10% off that fair value. That being said, it's definitely a stock on my watch list. It's not one I'm rushing out to buy right now, but I will be paying attention to their earnings release that comes out on the 17th. And I'll be paying attention to what Bill Ackman does with his 13F filing. But anyway, that's all I got. If you got any questions, comments, suggestions, or recommendations, let me know below, and I will see you next time.